Hey, it's Craig back with another Mortgage Minute. And today we are going to talk about the Federal Reserve rate hike that took place on Wednesday. And what does that mean in the short term for mortgage interest rates? And what are some expectations we can have in the long term for mortgage interest rates? But first, I always like to explain what does it mean when the Federal Reserve increases interest rates? Because I know there's a lot of confusion about that. And a lot of times we get calls right after that. It's like, oh my gosh, I heard mortgage rates are going up. And really, what they heard is that the Federal Reserve increased the Fed funds rate. So, real quick, what is the Fed funds rate? Well, I'm going to give you a very oversimplified explanation of this. And basically, this is the target rate that the Federal Reserve sets when banks need to borrow money from each other overnight. Again, this is an oversimplification of this, but banks have to keep a certain amount of money on deposit, and it's a percentage of money that they have loaned out because that's how banks make money, right? They bring deposits in and then they loan it out for things like car loans and home equity lines of credit. From time to time, a bank may be short on the amount of reserves they have to have on file, so they then have to borrow money from other banks overnight. They pay an interest rate for that. And again, the Fed funds rate is the target for that. Now, how does that impact you? Well, banks, when they turn around and make car loans or home equity lines of credit, they will utilize a rate called the prime rate. Okay. And really, what the prime rate is that's the Fed funds rate plus 3%. So the Federal Reserve yesterday increased the Fed funds rate to 5.5%. So what does that mean prime rate is now? Prime rate is now 8.5%. Okay, what does that impact? That impacts short-term loans. Think car loans, think credit cards, think home equity lines of credit if they're variable rates. All of those are typically tied to prime. So maybe it's prime plus 0, prime plus 1. In the case of credit cards, could be prime plus 10 maybe. So anyway, so that's what gets impacted when the Federal Reserve increases the Fed funds rate. Now, why are they doing that? I think that's the most important thing that you need to understand is why would the Fed be increasing the Fed funds rate? Their goal is to slow the economy down, not kill it. That's not really their goal, is to kill it. It's just to slow the economy down. And how do they do that? Well, one of the tools they have to do that is to increase the cost of borrowing money, which in effect eventually starts to slow the economy down, right? If you are planning on taking a vacation and you're going to have to put some of it on a credit card, you're much less likely to take that vacation if your interest rate on that credit card is 24% as opposed to 15%, right? That's a pretty big difference in what the interest cost is. That's the thought process anyway, that as they increase short-term borrowing interest rates, consumers will slow down spending, which in effect will slow down the economy. And what is the goal? The goal is to slow down inflation. Okay. So how does that impact mortgage rates? Well, you want inflation to be low if you want mortgage interest rates to be low. I mean, that's a very basic way of saying it, but I mean, I can't say it any better than to say when inflation is low, mortgage rates trend low. When inflation is high, mortgage rates trend high. Another way to think about it is when the expectation of inflation being low, mortgage rates will trend down. When the expectation is that inflation is going to trend higher or remain high, mortgage rates will trend up. Okay. I'm not going to get into all the details as to why that is. We'll do that on another video. But if you'll just trust me, inflation low, mortgage rates low, inflation high, mortgage rates high. So the Federal Reserve, by increasing the Fed funds rate, their goal is to slow down inflation. That's actually positive for mortgage loans. Okay. So what does it mean in the short term for mortgage interest rates? Well, the reality is the fact that they're increasing the Fed funds rate means there is a concern about inflation. Well, we already kind of knew that. So to a certain extent, that was already kind of baked into where mortgage interest rates are right now. But for the longer expectation of mortgage rates, if the Fed is successful in bringing inflation down, mortgage rates will come down. Now, the $1 million question is, okay, well, how much would mortgage rates come down? It's a great question. And to be honest with you, nobody can tell you that for sure. Here's a couple of ways I would tell you to think about it. The Federal Reserve is attempting to quote unquote land the plane. If you've read anything about the economy, you've probably heard the phrase land the plane. What does that mean? That means their goal is to get inflation down, but not completely wreck the economy. Okay. And so if they are successful, they will cause inflation to come down. Mortgage rates will come down. They won't come down as far as what might happen if we do go into a full blown recession. But mortgage interest rates will come down. All right. And my personal belief is the Fed always wins the fights that they fight. And as long as their goal is to bring inflation down, they will eventually get there. Okay. Now, if for some reason in what they're doing to slow the economy down ends up throwing us into a recession, and the reality is there's a lot of signs that we may be going into a recession, but the other part of that is we're coming off a pandemic, so maybe some of the normal signals of us going into a recession, maybe they're not as accurate. You know what? There's a lot that's honestly up in the air. If we do go into a recession, I think mortgage interest rates will actually go lower than they otherwise would. So what's the moral to the story? Mortgage rates are eventually going to come down. I think that's a pretty safe bet. Okay. Now, how does that impact you if you are somebody that's renting right now and you're thinking about, man, you know what? Should I buy now or should I wait? Here's the problem you've got. And I've been saying it and I'm going to keep saying it because it's absolutely true and it's going to continue to be true. Home prices are going to continue to go up. Okay. Regardless of mortgage rates. Yes. If mortgage rates get up to 15%, that's obviously going to impact home prices. But I don't think that mortgage rates are really going to trend up dramatically higher than where they are right now. So the reality is, I think home prices are going to continue to trend up. So if you're somebody that's currently renting and trying to decide, do I buy now or do I wait maybe next year and see if mortgage rates are lower? Here's the problem you've got. You're going to pay more for the house if you wait next year. You're probably going to have more competition for that same house if you wait until next year. And so, yes, if you wait until next year, my personal belief is that you're going to ultimately have a lower interest rate. But the problem is you're going to pay more for the house. And we're going to talk about this in future videos and show you real numbers. You're going to pay more for the house. It's going to cost you more money. Okay. Whereas if someone else today says, you know what, I'm just going to suck it up, deal with the interest rates where they are today. I'm going to buy the house that I can buy today. And then down the road, when interest rates come down, I'm going to refinance. Well, guess what? That person's going to pay relatively low cost to refinance. They're going to end up at the exact same interest rate that you are. The only difference is they're not going to pay $30,000, $40,000, $50,000 more for the exact same house. They're not going to be fighting with 10 or 15 other buyers for the exact same house because they didn't wait. They decided to go ahead and take advantage of what they could take advantage of right now. So it is really important to understand that concept. Now, if you're somebody that says, yeah, but you don't understand, I own a house today and my current rate is 2.75%. And I would like to buy another home, but I don't want to do it where the current interest rates are. You know what? To be fair, I get that argument and I understand that. I still say you're going to pay more for the house down the road, but you know what? The flip side is you're probably going to get more for the sale of your house. So the reality is I don't have a really good comeback for somebody who currently has a really low rate and they want to wait and purchase down the road. You know what? The reality is I understand that argument, but I'm talking to first-time home buyers. I'm talking to people that are renting right now. If you're making that same decision to wait, it's going to cost you more money. Okay. So again, to recap, the Federal Reserve did increase the Fed funds rate. I think in the long run, that's going to be positive for mortgage rates. They are doing what they need to do to fight inflation. And that's a really good thing for mortgage interest rates. But if you're a first-time home buyer watching this right now, I would not wait until mortgage rates come down because it will cost you more money. If you have questions about that, I'd love to talk to you. 615-498-5626. And I appreciate you watching.